Hello students, let us start today's session. In today's session, we are going to start a new chapter which is your equity valuation. Now this concept equity valuation is covered in your module 6. It is covered in your module 6. Now module 6 is basically bifurcated in two parts. Module 6.1 and module 6.2. So first we are going to learn equity valuation. Then we are going to learn bond valuation. Bonds, debentures, preference shares valuation. So basically we are going to learn valuation portion. We are going to learn the value of stock, shares, debenture, bonds. We are going to learn the valuation part. Now this module 6 is covered in your section B. Now is this concept important from exam point of view? Answer is yes. It is important for the question can come, short questions can also come, MCQs can also come, and comprehensive question can also come. MCQ definitely is going to come from equity and bond valuation. This is for sure. Okay. So this is it a tough chapter? Answer is no. It is very easy to learn and understand, an interesting concept also. So there is nothing complex in this chapter. So first we are going to start with equity valuation. Now before getting into the technical portion of equity valuation, let us first understand little basics about it. When we are going to learn this concept, how to value equity, we are going to use two approaches. Even though there are more approaches also, but in your course only two approaches are there. And also let me tell you one thing, this chapter equity valuation, bond valuation is introduced in 2022 course, new syllabus. It was not there earlier in the old syllabus. This is a concept which is there in the new syllabus. Okay. Now going further, equity valuation we are going to start. Now while doing equity valuation, while valuing a share price, how much should be the share price, we are going to use two approaches. One is discounted cash flow technique and another is relative valuation technique. So two techniques we are going to focus. In this lecture I am going to focus on discounted cash flow technique, which is also referred as capitalization of income method. Why it is called capitalization of income method, I will explain it also, but just remember for time being that this method, which method? Discounted cash flow technique. Discounted means that you are going to find out present value of certain cash flows. This technique is also called as capitalization of income method. Okay, so let us start this concept. Before starting, let me first go on and making you understand what is valuation. How do we value? Okay, so let us first start with the concept valuation. Then we will go on to equity valuation. Now the question is, yes. Yes, please observe. Now the question is, we are learning asset valuation. Shares are assets. Please pay full attention. Lecture has started. Now slowly common sense concept will convert into technical part. Okay. Now asset valuation we are discussing. Here our asset is going to be any company's ordinary equity share. Ordinary equity share. Now what do you mean by valuation? For example, let me ask, this is a pen. Now according to you, what should be its price as on today? What should be its value as on today? How do we decide that this pen should be selling at 20 rupees in the market, or 30 rupees, or 500 rupees, or 5,000 rupees? How do you decide the value of this pen? I just want to know, how do we decide value of an asset? In our case, pen. So very simple. Currently I might be paying 20-30 rupees for this pen. Let's say 20 rupees I am paying, and this pen works for me for 10 to 15 days. After 15 days I have to purchase another pen. Okay, So I am spending rupees 20 and I am getting a benefit from this pen, that is, it is going to work for 15 days, right? Suppose in the market there is another pen which is going to work for, let us say, 5 months. Okay, it has got a ink which will work for 5 months. Then definitely I am willing to pay more for this pen. Value of this pen will increase. I might pay, let us say, 100 rupees for this pen or 80 rupees for this pen, because it is giving me more benefit. And if somebody introduces a pen in the market which will work forever, which will work for perpetuity, which will keep on working and its ink will never end. If any pen will give me service work forever, then I might be willing to pay 1000 also for this pen. So that what I am trying to teach you here is that if you get more benefit from asset, if you get more benefit from the asset, its value is tend to increase. That means value of an asset depends on the benefits we derive from this pen. So this is the conclusion that we are driving, that value of an asset depends on the benefits we derive from the asset in future. If you are going to derive more benefits in the future, if you are going to get more benefit from this pen, then you might be willing to spend more on this pen as on today. So if you are studying valuation, you need to understand that when you are doing valuation of any asset, be it a share, debenture, bonds, you have to observe what benefits you will get, in future. You will get in future. Then only you can decide how much you are willing to pay for this pen, what should be its fair price as on today, what should be its justifiable price as on today. So that means if I want to learn, now I am coming to my main concept, that is valuation of shares. Valuation of shares. So if I want to value a share as on today, equity share, if I want to value a share, this is an asset, I want to know what should be the fair price of share as on today. If I want to know this is my target. Then on what thing should I focus? If I want to value this share, I have to focus on the future. What will I, as an investor, since I am investing in this, as an investor, what will I get from this share in future? So that means I have to focus on the future. What do you get from this share in the future? When you invest in a share, what do you get from the share? Very simple, ma'am. We get dividend from the share. Dividend can be paid by the company annually. It can be paid annually. Dividends are declared by the company half yearly also. It can be paid quarterly also, which are called interim dividend, when it is paid before your financial period is over. If you get a dividend quarterly, if you are paid half yearly, you are paid, then it's called interim dividend. So whatever dividend you are going to get in future, if you are going to get, this is the benefit you are going to get from the share. Any other benefit associated with share? Yes. When you buy a share for, let us say, 10 rupees, and let us say you buy it for 5 years, and after 5 years you are expecting you are going to sell this share for 25 rupees sales price. So after 5 years you will be getting how much from this share? 25 rupees. So that means at the end sales value you are going to get period whatever your your investment period is, after your investment period, when you want to now get out of this investment, after that you will going to sell your share and going to realize the share price. So sales value of share, right? So can I conclude here that these are the two cash flows? See, what am I saying? These are the two, what are two cash flows associated with shares. This is what you will get from shares, nothing else. Either you will get dividend, which can be received annually, half yearly, quarterly, or you will get what? At the end, you will get the share price. These are the only two cash flows. Inflows are related to the, if you invest in a share, right? So if you want to know, if you are going to get lot of dividend, if you are expecting from company that company is going to pay lot of dividend to you, then you are willing to pay more value for the share as on today. What am I trying to say? Let me repeat again. Suppose, I'm just talking generally. Suppose, for example, you think company is going to pay, let us say in future, 100 rupees of dividend. Then you might, I'm just writing it, you might spend today on purchasing share 10 rupees. If you are being told that company is going to pay 1000 rupees dividend, since benefits are increasing, you might spend more on this share to buy, right? You might spend, let us say, 100 rupees. So my purpose is here to explain you and make you understand that when you get more benefits in future, this is very important. Now the word is coming future. When you expect from an asset that in future you are going to get more benefit, more cash inflows are going to come, then you are willing to pay more value for the asset. That means value of an asset increases if your future associated cash flows increases. Now since these cash inflows, let me explain here please. Now these cash inflows, that is dividend and at the end of the period of investment sales value of the share, these benefits you are getting in future. Okay, so let us write it here. Yes, benefits are coming in future. Benefits are coming in future and you are trying to understand the value as on today. Value as on today. So very simple. Whatever benefits you are going to get in future cash flows, just find out their present value. The present value of these benefits, present value of these cash flows is your value of an asset. What are we going to do? Whatever future cash flows you are going to get, we are going to discount them. Discounting means finding out present value. I hope you have studied section A where you have understood the capital budgeting part, where you know how to find out present value and future values, right? So present value, discounting, you know it. I am assuming that. So discounting means finding out present value, finding out present value. So whatever benefits you are going to get in future, just find out present value. Whatever present value will come, that is the value of an asset as on today. It is that simple. So that is why the first approach that we are going to use is named as, when you're going to value equity shares, the first approach is named as discounted cash flow technique. Whatever cash flows you will get in future from shares, just you have to discount them and find out its present value. So is it tricky or not? Not at all tricky. Why? Only two technical portions you have to understand. Two technical part you have to understand. What technical part you have to understand? How to compute, how, even though I have explained in the basic concepts of capital budgeting, but still I am going to explain it again because it is relevant here too much. How to find present value of perpetuity, or let me say in cash flows forever. I'll explain. cash flows forever. And another thing, this we have to learn in this lecture itself, how to find present value of growing perpetuity. Because ultimately we have to just learn, understand, see what benefits a share will give you. How can I tell you what I only know that shares can give us two benefits, dividend, or shares can give us two benefits, dividend, or it can give us sales value. How much dividend company will give, how much sales value will come after a period of investment, that question will tell us. So this information, dividend and sales value, will be given in the question itself. We just have to learn how to find out its present value. In these two cases, in normal cases, we know how to find present value only in perpetuity and growing perpetuity. And why is it relevant here? I am going to explain now. This is my next area which I am going to teach you. Now, why is this word perpetuity? Why is this word perpetuity? Forever. Why are we focusing on the word perpetuity? Means forever, something which is coming, going forever, which is going to run forever, that is called perpetuity. Okay. Now, why are we focusing on word perpetuity? Because of a very simple reason. We are talking about shares. We are talking about shares. Now, we are talking about shares, right? Now, shares of a company. Now, we know, we have learnt in 11th, 12th class, company, when we are talking about company, we assume going concern assumption. Going concern assumption, that is, that company is going to run for 5 years, 6 years. Whenever you're going to open a company, when you're going to start a venture, do you ever think that I'm going to run this venture for 2 years, 3 years, 4 years? No, you always assume that this venture is going to run forever. This is called assumption. We assume that organization is going to run forever. So when somebody invests in shares, it is assumed they are investing in company, and company will run forever. So what benefits you will get from share? You get benefits. What benefits you get from share? Dividends. So this dividend is going to come for 1 year, 2 year, 3 year. Obviously these dividends will go on coming till the time company is going to run, and we assume company is going to run forever. So hence we assume that dividends are going to come. Dividends, cash flow are going to come forever. So when this type of assumption is made, then how will you value and share value of share? How it is done? When you assume going concern assumption. In that case, let me repeat myself again. Since you are assuming that you are investing in a company which is going to run forever, you are never going, if you assume you are never going to sell shares, you are going to invest your money in this company forever, then obviously sales value at the end, that cash flow we will not consider, because you are investing it in this company forever. So you are never going to sell your shares. So only one inflows are associated with the shares. Only one cash inflows are associated, that is dividends, which are going to accrue to you forever. Now a benefit which is going to come forever, these dividends are going to come in future. How will you find? See, in year 1 you will get dividend, in year 2 also you will get dividend, in year 3 also you will get dividend. This will go on till forever. Now how will you find these dividends? Present value, because that present value will be the value of share as on today, value of share as on today. So that is why we have to teach you how to find present value of perpetuity inflows. How to find present value of inflows which are going to come till perpetuity. Inflows till perpetuity, forever. So this is my target now. This is, I am going to explain you this technical portion. How do we compute? Because once you know how to find something which is coming in future forever, its present value. See, if only dividend comes for 3 years, I can find out its present value. How? Very simple. These are future inflows. These are future values. I will multiply with present value factor and I will get present value. Suppose if it's a 10% present value factor, so I will multiply with just a minute. One divide by 1.10. If 10% is the time value of money, so you get 0.909. Then again we are going to press equal to. For second year you will get 0.826. Then similarly you are going to multiply here, equal to again 0.751. You will multiply, you will get the present values, and then you will say this is the present value of these future dividends. So hence this is the present value of the share. This should be the value of share as on today, justifiable value of the share. But since you are assuming going concern assumption, these dividends are not just going to come for 3 years, they are going to come forever. Since we are assuming an investor is, ma'am, you might ask, ma'am, but normally investors do not invest forever. Yes, you can consider that thing also. Questions will be there like that also. Questions will be there that you are making an investment only for 5 years. No problem. Whatever inflows are coming for 5 years, you just find out its present value. But there can be investors who invest in a company with an assumption. Assumption means you assume that you are going to make this investment forever. Then how the valuation will be done? Because valuation will differ when the benefits will differ. I hope I am making myself clear. So what is now my target? My target is to teach you, which I have already taught in the basic lectures of capital budgeting, basic lectures, how to find present value of perpetuity. How to compute present value of perpetuity inflows annuity case. For example, let us take an example. Okay, now example is, suppose I wish to give prize money. I wish to give prize money of 1 lakh rupees. This year I want to give prize money of 1 lakh, and I want that whichever student tops, whichever student gets first rank in CMA final exams, first rank, that student should get 1 lakh rupees from me. Every year I want to do this announcement and give this distribute this prize money. Okay, now till the time I'm alive I will be doing this. I will be giving 1 lakh, but once I die, then nobody is going to make payment of 1 lakh rupees from on my behalf. So I want to do some arrangement. I want to do some arrangement, such an arrangement that this cash prize is given even after I die. So I want to make such an arrangement. I want to make some investment. I want to make some investment on which the return on that investment is equivalent to 1 lakh rupees. Therefore, every year 1 lakh rupees of prize money is given to students. Even whether I am surviving or I am no more there, still this 1 lakh rupees is paid. Okay, so I want to make such an investment, and I have gone to bank and I have asked their rate of return. Their rate of return, and they have said that the rate of return is 10%. So this is basically time value of money. Money is growing at this rate. Time value of money also you can say. Okay, so I am asking bank that how much should I invest? How much investment should I make? That on that investment, if I get rate of return, or which is called time value of money, is 10%, right? How much investment should I make so that every year I get a benefit of, or I should get a return of, or I should get a cash. These are all words which I am going to using. Cash inflow every year. Until how many years I want this 1 lakh rupees? I want it forever. I want this. So I have to make the investment also forever. Not a problem. I will make that investment and I will forget then. So this cash inflow will come forever. I want 1 lakh rupees, and bank is saying the time value of money that we are offering, rate of return that we are offering is 10%. So very simple common sense. On this investment, 10% will be the rate of return. So how much will I get? X into 10% is equal to 1 lakh. So X is equal to 1 lakh divided by 10%, which is 10 lakh rupees. Let us calculate on the calculator. 1 lakh divided by 10% is 10 lakh, right? So basically I have to make an investment. I have to shell from my pocket. I have to shell out this much of money as on today in order to get 1 lakh forever, right? Each year per annum I want this amount forever. This much amount of investment I have to do it today. So this is the value of my investment, correct? As on today. Similarly, so that means, can I find present value? This is how I'm trying to find out. This is what this 10 lakh represents. What? This 10 lakh is the value of investment today. This investment I have to make today. So can I say this is the present value? Can I say, yes, can I say this is the present value of future inflows? This is present value, correct? Okay. So if I want to find out, now I want to make a formula out of this. This X is what I am trying to find out, present value. How much should I make investment as on today? So this is present value. Present value. How I have computed present value? 1 lakh was the future inflows which I am going to get. So future value of cash inflows which will come till forever. So let me write it again. Every year I am getting the same dividend, 1 lakh, every year I am going to announce the same prize money. When every year the amount of outflow or inflow, or let me say whatever the cash flow is, every year if it's same, it is a case of annuity. When every year cash flows are same, it's a case of annuity. So can I say this is future value annuity for perpetuity? Yes. Divided by what figure we have divided this amount? 10%, right? So 10% was what? Rate of return or time value of money. Can I write like this? Rate of return. This is the return for me, but for bank it is cost to them, cost of capital, or I can say time value of money, right? So this is when I have to find present value. If I want to find present value of what? Of inflows that is going to come forever, which is called future value annuity. This annuity is going to come. Annuity means every year amount is coming same forever. Then this is how you are going to find out the present value, by dividing with the time value of money. So the same rule I am going to apply in my shares valuation, where dividend is going to come forever. So how much investment should I make in my share as on today? So do not forget about this formula. Do not write also. Let me first finish, because I have to teach you two concepts. I have to teach you these two concepts. First concept, I have taught you how to find present value of perpetuity. Now I am going to teach you how to find present value of growing perpetuity. Okay. Then we will come back to our main concept, which is your share valuation. Yes. So now the second concept. Now this prize money which I was offering to students, 1 lakh rupees, every year I want this prize money to be given every year, right? So students are very happy that every year ma'am announces 1 lakh rupees of prize money. Second year also they are happy. But after 15-20 years, do you think, or maybe after second or third year also, this 1 lakh amount will not make them happy, because the value of money drops every year. Today's 1 rupee will have more worth than 10 years after. If I give somebody 1 rupee, that will not hold that much of worth. So every year worth of money is dropping. Say it like this: purchasing power of money will drop. Whatever you can buy today from 1 lakh rupees, you cannot buy the same thing with 1 lakh rupees after 10 years. So this amount students will feel like that this amount is like a peanut for them after few years. So because inflation is rising, so I want to beat inflation. I want to grow this money. Let us say inflation rate is, let's say 5%. Okay, so I want that every year now bank just does not give me 1 lakh, it gives me increasingly. I want my perpetuity to grow. I want perpetuity to grow. That means I want that first year, if I am able to receive from bank 1 lakh, then second year this amount should increase by 5%. So second year I should get 1,05,000. Then bank should offer me on third year, I should get on 1,05,000, I should be able to get 5%. That means 1,05,000 into, let's say 105%. So I should be getting 1,10,250. 1,10,250. So on the previous year, whatever inflow I'm getting from bank, from my investment, every year this return should increase by 5%. This I want. This is called growing perpetuity. This is called growing perpetuity, and growing rate I have mentioned. For example, this is an example, okay. For example, growing perpetuity is 10%. Bank is offering a rate of interest 10%. Same question. My purpose has only changed. I just now want that the inflow from bank should grow with 5%. So now you want more benefits. Now you just do not want only 1 lakh, you want it to increase also with 5% every year. Now how much should I invest as on today? Question is, how much value of investment should I do as on today to get growing perpetuity inflows, growing annuity inflows, or annuity, or should I write perpetuity? Yes. So how should I get this figure? Very simple. There is a formula for it. I will justify the formula also. Now, how much should I value of investment as on today? How much should you invest as on today? Investment as on today. Same formula that we have just learned, just little change we are going to do. Whatever your future value annuity is, just divide that by your time value of money. Whatever time value of money is, just subtract the time value of money with the growing rate in percentage. That is, what is the formula that you have just used previously? You have used this formula. It is mentioned here. This formula, if you want to find out present value, that is how much investment you should do, then whatever future value annuity is, you just divide by the rate of interest or time value of money. Same I am going to do here. Just subtract the growing rate. So I want the first year to get 1 lakh. 1 lakh I want every year. Plus I also want it to grow with 5%. 5% on last year inflow, I want it to grow with 5%. So time value of money is 10%, but growing rate I want 5%. So 1 lakh divided by net is 5%. Now if I divide this, 1 lakh divided by 5%, so 20 lakh. So my dear students, you have to invest 20 lakh as on today. This is value of an investment you have to do today, as on today. If you invest 20 lakh, then only you will be able to get this amount. 1 lakh first year, second year 1 lakh 5,000, then third year 1 lakh 10,250. Let us check whether this formula works or not. Suppose if I invest 20 lakh as on today. Suppose I invest 20 lakh today. So what do I get? Let's see. At the rate I have invested, at the what rate? 10%. Bank is offering me 10% rate. So on 20 lakh investment, how much return on the first year becomes due? So this comes out to be 2 lakh. Now in the first year, bank will distribute how much? First year I want only 1 lakh rupees. First year I want, bank is earning on my money 2 lakh, but it will give me only 1 lakh. Okay, it will distribute me only 1 lakh. So how much is left? Left portion is 1 lakh. Now this 1 lakh will get added up to 20 lakh, and this will become how much? 21 lakh. So my investment is growing. Investment will grow, so return will also grow. Next year it will yield how much? 2 lakh 10,000. Then next year you want this inflow to increase by 5%. So bank will distribute in the second year, bank will distribute 1 lakh 5,000 out of this money. Yes. So if you see here, yes. So if you see here, bank will distribute 1 lakh 5,000. So how much is left? Out of 2 lakh 10,000, out of 2 lakh 10,000 bank earned on your money, but it gave you only 1 lakh 5,000. So that means 1 lakh 5,000 is left. It is not always necessary that half will be distributed, half is left. What is required will distribute you, and remaining is added to your capital. Okay. Now in this your capital is increasing. Now the capital is 22 lakh 5,000. Now in the next year, yes, 22 lakh 5,000. Now next year on that 10% you will earn, so it will come out to be 2 lakh, yes, 20,500. Now third year, how much money you are expecting? You want this money to grow by 5%, so it will grow by 5%. Yes, so it will grow by 5%. So how much money you want? 1 lakh 10,250. So you will receive 1 lakh 10,250 out of this money, and how much is left? Simple calculation. So 2 lakh 20,500 minus 1 lakh 10,250. So you are left with 1 lakh 10,250. Bank is left with this amount. So bank will increase your capital with this amount, and now bank will have how much of capital? Let us see. Bank will have, earlier it had, your amount was invested 22 lakh 5,000. Now this amount is going to increase with 1 lakh 10,250. So now bank has 23 lakh 15,250. This is how capital is increasing. Again, this will go on like this. Hence we can see very much that every year you are getting your inflows, your return. Every year your return is increasing. First year you got 1 lakh, second year your prize money which you will distribute will be 1 lakh 5,000. Third year you will distribute 1 lakh 10,250. Every year from the last year inflow, 5% inflow is increasing, because your amount which you made investment. So this investment value 20 lakh is calculated in such a way that your return is increasing, and this you can keep on getting till perpetuity if you do not withdraw your investment. So this is your value of investment. This is the formula that you are going to use if you want if in the company. Now coming back to shares, when we are going to start learning about shares, there when question says that company is going to give you dividend every year, that dividend is going to grow every year with 5% or 6%, how much should be the share price as on today, then there we are going to use this formula. But these formulas are to be used when you are going to get the dividend forever, okay, when you are assuming going concern assumption. Now I would suggest you to write this formula, whatever we have written, then we are going to start with our formally we are going to start equity valuation. This is the concept that is going to be used in learning equity valuation. So I would suggest you to write it from here, technical part. I am just going to enlarge the screen. You can write whatever you wish to write. Yes, let me start from here. Yes, please write it down. Start from here, please. This is equity valuation. Module 6. I am scrolling the page. I haven't explained these three important terms. I will be just now going to explain these terms. So do not write. Just this is also I haven't explained. This is what I have explained. Does dividend drive the market price of the share? Yes. Share of market price of a share. Yes, market price of a share as on today, share value as on today does depend upon the dividend that we are going to get in the future. If we are going to get more dividend, definitely share value as on today is going to rise. So yes, okay, that is what we have explained. Please write it down. I am scrolling the page. I'm scrolling the page. Pause the screen, write it down. I'm scrolling the page. Please write it down. Pause the screen and write it down. I'm scrolling the page. I'm scrolling the page. I'm scrolling the page. I'm scrolling the page. I'm further scrolling the page. I'm further scrolling the page. I'm further scrolling the page. Pause the screen and write it down. Yes. Now let us move on to the very basic terminology. Yes. Now let us understand very basic three important terms. You might be knowing also, I'm just brushing it up because these words will be used. These are the three words: dividend rate. What is difference between dividend rate, dividend yield and dividend payout? That is my target here. These are three important terms which will be used in equity valuations. So now in next 30-40 minutes we will be doing proper questions on equity valuations, and believe me, it is very easy chapter. Okay, so let us start. What is dividend rate? Now this is an example I have written here. A company A's share information is given to you. Face value is given. Face value is 100. Currently this share is in market selling at 150 rupees. So market price is mentioned. Current dividend per share is 10 rupees. Earning per share is 20 rupees. Okay, so currently company has given a offered or given a dividend of 10 rupees, but company earned on this share 20 rupees. Now the question, first part of the question is saying what is computation of dividend rate. So how do you compute dividend rate? What is the rate of dividend? Rate means percentage. So percentage of dividend given to you. How much is the dividend offered to you? 10 rupees. This dividend is offered to you. You have to compare it with face value. So how much is the face value? 100 rupees into 100. So basically it is coming out to be 10%. Now what do you have to memorize here is the dividend rate is always computed on face value. Okay, when company has issued shares, at that time the face value of the share was 100. So when dividend rate is mentioned by company, because market price of a share keeps on changing in the share market, it keeps on changing, it keeps on fluctuating every day. So you cannot just the percentage will keep on changing. So common parameter which is used by company is dividend rate. They tell you that on face value this much percentage we are going to offer dividend. Okay, so dividend rate is measured on face value. But as an investor, I have not invested 100 rupees. If I have purchased this share, I have not invested 100 rupees, I have invested 150 rupees because this is today's market value. So I want to know dividend yield, that is how much yield. Yield is what? Yield means return. How much return I am getting on my investment. That too in terms of dividend. This return have to be measured in terms of dividend. How much dividend I am getting on my investment. So my investment is not 100 rupees. No. Currently market price of the share is 150 rupees. That is my investment. On that investment I am getting 10 rupees of dividend. So this is the rate of dividend I am getting. That is the dividend yield. Okay. So very simple. 10 divided by 150. So it is 66, just a minute. 6.67%. 6.67% is my dividend yield. So what is the formula that is coming out of this dividend yield? The formula is very simple. You have to write dividend in the numerator and your investment, that is your market price per share, into 100. Or I can say dividend per share upon market price per share into 100. Is it clear? So how do you remember this formula? Very simple. When they are asking you dividend yield, yield means you are asking from investor's point of view. He wants to know how much return he is getting on his investment as on today. Now the third part. Third concept is dividend payout ratio. How much proportion of dividend is being paid. Now this proportion is in comparison to what? Company, when you invest your money in the share, company earns on your investment. See, you are making an investment in the company, you are providing capital to the company. On this capital, company makes money, earns money or makes money. I prefer using word makes when you're talking about company. When you do job, I prefer using word earning. Okay, so on this capital, company makes money for its investors. This capital has been provided with lots of investors. Shareholders are providing capital, preference shareholders are providing capital to the company, then debenture holders, bonds, all these people are providing debt. From debt also company raises capital. So this capital is comprised of equity and debt both, right? Owners have provided the capital and lenders have provided the debt to the capital to the company. On this capital, company's aim is to make earning. So whatever company makes earning, that is called EBIT. Very simple. I know you know all these terms, but still I am reading it again. Earning before interest and tax. Now from this earning, who will get the return first? Because these are also investors and these are also investors. First, the lenders will get their return. So first, interest on lenders' money, interest on debt is paid. Then whatever earning is left, on that government will come and eat the money. Earning after tax, right? Now from this earning, yes, on this earning, let me write here, earning after tax. Now government has got its dues. Now this earning belongs to owners. Now there are two owners. First is your equity shareholders and another is your preference shareholders who get preference while getting the dividend. So first they are paid the dividend, preference shareholders dividend. Now I hope you know preference shareholders dividend rate is prefixed. It doesn't change. So they will get a fixed income. Now whatever income is left, this remaining portion is called residual earning. Now this residual earning, the remaining earning is available for equity shareholders. This is available for equity shareholders. Now equity shareholders, out of this residual earning, some portion is divided to them, is given to them as dividend, equity dividend, and remaining income is retained by the company for running the business, retained earnings. Now suppose, for example, if company is the residual earning is 100 rupees, okay, residual earning which is available for equity shareholder. Out of this, let us say 40 rupees is distributed as dividend and 60 is retained. So question is asking you, what is the dividend payout? What is the dividend payout? So basically it is asking you the dividend payout ratio, that is how much was the earning available. So in our example, earning available was how much? So in our example, the residual earning is 100, for example, and we have just paid dividend was 40 only. This much only dividend paid out. So what we are going to do is, in the dividend payout ratio, basically this formula is what is the earning per share upon, this is DPS per share into earning per share. Basically it implies that the earning which was done, the residual earning, this is the residual earning. If you divide residual earning with number of shares, you get earning per share. So earning per share in our example was 100 rupees, right? And you have dividend payout only how much? 40 rupees. So 40 divided by 100 into 100. So basically 40% is your dividend payout out of the earning which company has earned for you. So, and also please see here, how is EPS, earning per share, is computed. Earning per share is computed not by dividing retained earning. No, from residual earning, let me write it here. Yes, from residual earning, dividend is paid to equity shareholders and whatever is left is called retained earnings. Correct? So retained earnings are basically it is a reinvestment. It is reinvestment by company in the company's business. So owners are basically shareholders have earned this money, but they have only got this much money in cash form, and remaining money they have reinvested back in their company, and this will increase the value of the company. Okay, so coming back, you have understood what is dividend payout. Dividend payout formula is dividend per share divided by earning per share. That is how much earning, residual earning company has earned into 100. Basically how much proportion of dividend has been paid from the company's earnings of equity shareholders. Earnings, this residual earning can also be termed as earnings available for equity shares. This can also be written like this, equity shares. Okay, so we have learned three basic terminologies. One is we have learned what is dividend rate. Basically it is nothing, very simple, just divide dividend per share divided by face value into 100. What is dividend yield? Dividend per share divided by market price per share. And what is your dividend payout? Dividend per share divided by EPS into 100. Okay, so these are three terms that we have written here, explained you. So before going further, please copy all this. I am enlarging the page. Yes, please note down. Pause the screen and write it down. I'm scrolling the page. Please pause the screen and write it down. Pause the screen and write it down. I'm scrolling the page. Pause the screen and write it down. I'm scrolling the page. Pause the screen and write it down. Please do write this chart. Basically, it is like this: EBIT minus interest on debt. Then you get earning before tax. Then you subtract tax. You get earning after tax. Then you subtract preference dividend. Then you get earning available for equity shares. Earning available for equity shares, equity shareholders. Then you subtract equity dividend. Then you get retained earnings. Please write it down. Pause the screen and write it down. Pause the screen and write it down. Now, can we start doing questions on equity valuation? Can we start doing questions on equity valuation? So answer is yes, we can start now doing questions in equity valuation, even though I have not taught you any formula, but we are going to use the approach. We are going to use the approach. Which approach? We are going to use your discounted cash flow technique. and after solving the question, then we will create a formula. Okay, so now let us start with the questions of valuation of equity shares, and the questions that directly we are going to solve it from CMA module. We are going to directly solve it from there itself. Okay, so I have given questions in my book directly from CMA module. So this is your module 6. This is the part of the book that I have provided. Okay, now this is your module 6, equity valuation, discounted cash flow based on valuation, then relative valuation also we will do later on. Let us start with question number 1. Let us start with question number 1. Now this question number 1 is based on no growth model. There is no growth, dividend will not grow, whatever we have learned without growth. That is, we have learned this part. I have explained you this portion. Let me show you how to find present value of perpetuity without any growth, right? No growth. So first part we are going to, first part of the concept we are going to apply in valuation of equity shares. Okay, let us start. So the question says, the first question says, India Incorporated currently pays a dividend of 10 rupees per share. Currently pays the dividend of 10 rupees. So is this dividend is the dividend which will be paid next year for in the future, or this is current dividend? Current dividend I will represent by D0. Okay, and it will be constant during the lifetime of the corporation. This is, they are trying to tell you that this dividend will continue constantly. That is, it is a case of annuity. Every year you will get the same dividend for lifetime of the corporation. Lifetime means that they are going to trying to tell you going concern assumption. They are not mentioning any year that this dividend will be paid till 10 years, 5 years. So let me read again. Question says, India Corporation currently pays a dividend of 10 rupees per share, and it will be constant during the lifetime of the corporation or in perpetual time if required rate of return of the investor is 14% a year. So they have also mentioned time value of money, that is rate of return. What will be the value of stock using zero growth model? I haven't discussed or introduced this word. This word is nothing. They are just trying to tell you that there is no zero growth. There is no growth in the dividend. Dividend will remain same. So using that model, tell the valuation. So very simple. So we are doing valuation. Now we know the model that we are using is zero growth rate model. Now you know, please tell me in the, I have to find out the value of the share as on today. So what is the value of share as on today? Very simple. When you are going to get the benefit from this share, every year same benefit you are going to get. So what is the formula? Whatever you are going to get in future, every year same divided by the time value of money. This is the formula that I have told you, valuation. Same formula I am going to apply. Here the asset is this is your illustration number 1. So here the asset is your share, right? Now from this share, what are the associated cash flows? In this question, currently the associated cash flows are future dividends. Now how much will be the future dividend? I want to know future value of annuity. Every year how much dividend you will get. So question said currently we are paying 10 rupees, right? Yes. So currently the dividend is how much? 10 rupees. Since there is no change in the dividend, there is no growth. So in future also, in the next year also, dividend will be 10 rupees, and this will continue till infinity. 10 rupees only will be paid every year. 10 rupees will be paid, right? So this is what we have to write, future value annuity. Every year you will be getting 10 rupees of dividend, and time value of money or rate of return is how much? 14%. So very simple. just a second, 14%. So yes, so 14%. So what is the present value, future value annuity upon rate of return? So future value annuity, every year you want a rate of return, how much? 10 rupees, you want 10 rupees every year. So how much investment should we do if money is growing at the rate of 14%? So let us find out the calculator. Yes. So very simple, 10 divided by 14%. So you get 71.42. So 71.42, 43, let us write it, 43 or 428. This is the value of stock as on today. If you invest this much as on today at the rate of 14%, you will be getting 10 rupees forever. This is your value of stock as on today. Okay. Now, if you see here, this is the answer which is coming, 71.43. This is the value of asset as on today. If you want to have a rate of return is 14%, if you want to have 10 rupees forever. Now what is the formula in this case? Now can I write the formula in this case for the valuation of shares? So if you are talking specifically for valuation of shares, then the formula should be like what? What is 10 rupees? This was your dividend. You can write here D0 also, D1 also, because this is a zero growth model. Better is D1 you should write, even though they have written D0 in the formula, but you should always write, because this is the future benefits that you are going to get. D1 divided by cost of equity. See, this 14% is the rate of return investor expects from the company. This 14% is the return for investor, but who is giving you this return? Company. So for company, this 14% is cost to them because of the equity shareholder. So basically for them it is cost of equity. So you can say it is KE also, cost of equity, which you have studied in inter level also. Much detail is not required. Simply money is growing at the rate of 14% for investor and for the company. Company has taken money from shareholders. They should be given a return of 14%. Return is for investor and cost is for the company. So you can refer here this formula as KE. So basically now the formula comes value of share, zero growth model, growth rate model where there is no growth. Very simple formula. Basically this formula is of present value of perpetuity flows. So formula is very simple. You just have to divide dividend with the cost of equity. Okay. And here dividend you can write D0 also, or you can write D1, because these both are same. These both figures are same because there is no growth. But effectively this should be the formula. Okay, because you are trying to find out what you will get benefits in future from this share. That benefits present value you are trying to find out. So this is the first formula which you have to memorize. This is formula number 1 for valuation of shares, which is nothing. It is only just finding out the present value of future cash inflows. Now moving to the second question. Let us move on to the second question. Second question says, India Incorporated is expected to grow at the rate of 8% per annum. Every year company is going to grow at the rate of 8% per annum. So they are mentioning you the growth rate. This is your growth rate. Correct? Then which currently pays a dividend of 10 rupees. Now this is not D1, this is D0. They are currently paying D0. For investment at this risk level, investor requires a return of 15%. Okay. So this is the return for the investor, but this is cost of equity for the company, right? Yes. This is cost of equity for the company. What is the estimated value of the stock? So very simple. We have been given figures. Let me write the figures. This is illustration number 2. Yes. So first information they have paid, given to you, D0 is 10 rupees, right? Then they have mentioned growth rate. Growth rate is 8%. Cost of equity, the return the equity shareholders want is 15%. Then what else you have been given? That is it. We have to find the this much information is given to us. Now we have to find out the present value of the share, right? Value of share, value of stock. So very simple. What formula we have learned? Let us go and check what formula we have learned. Yes. When there is a growing inflows, when you are getting benefits with the stated growth rate. In this case, we wanted the growth to be 5%. In our example, if you remember, inflation was 5%, so we wanted the returns to grow at the rate of 5%. When your returns are growing at the rate of 5%, can you see? Then what formula I have told you? Whatever future value annuity, whatever future value benefit you are going to get from the first year onwards, write that, first year onwards, then divide with the time value of money minus growth rate. Same formula I am going to put here. What is the benefit you will get in the first year? First year you will get 10 rupees of dividend. No, every year dividend is going to grow at 8%. This is a dividend we have already received. In the coming year, so I want D1. What is D1? Whatever dividend you have got, you have to increase with the growth rate. So it is going to be how much? 10.08, right? This is your D1. How have you computed D1? D0 into 1 plus the growth rate. Just writing the formula. Simply, you just have to know how much dividend you will get in the first year. Every year dividend is going to grow at the rate of 8%. So D1 I am writing here how much? 10.08. Now divide by what I have taught you, time value of money minus growth rate. Same thing I will do here. Time value of money is 15% minus 8%. Just do a little correction. This is 10.80. 10.80. So let us start. So here it is going to be 10.80 divide by, now the return the investor wants 15% minus the growth rate 8%. So how much you get? 10.80 divided by 7%, right? Now let us solve it on the calculator. It is 10.8 divided by 7% equal to, so it's 154.28. 154.28. This is the value of share as on today. Now what do you have to memorize in this question is that the formula here, this is very important. You have to memorize that this represents what benefits you are going to get in the first year. That will grow with 8%. So first year you get D1. So formula always use D1. Here in no growth model, it doesn't matter whether you use D0 or D1 because that figures will be same. There is no growth. But here it does matter. Formula requires D1 divided by, so formula becomes what? Formula becomes D1 divided by time value of money is cost of equity minus growth rate. This is the value of share in growth model, growth rate model. Correct? So this is simple calculation, value of shares. Please write it down. This is up, we can do up to till question number 2 because we have just understood that portion only. Okay, please write down the solution. I am enlarging the page. Yes, this is your illustration number 1. Please write it down. Very simple, and even the upcoming questions are also very simple. Pause the screen and write it down. I am scrolling the page. This was basically valuation of equity share CMA module. this type of questions can be asked directly in MCQ, because you just have to put the formula. I'm scrolling the page, pause the screen and write it down. I'm scrolling the page, pause the screen, write it down. I'm scrolling the page. Yes, so we have done 2 questions. Now we have to study valuation of shares, and we have to study valuation of preference shares and valuation of bonds, debentures. Which is more difficult? This is the discussion they have done on the first page of your valuation of equity. That is valuation of equity. Listen, please focus here. Valuation of equity shares relatively more difficult than valuation of debenture and bonds and preference share. Answer is yes. Equity shares valuation is more difficult as compared to debentures or bonds valuation. Why? See, all this valuation depends upon 2 things. All these valuation depends upon, basically valuation of any asset depends upon the benefit that we are going to get in future from this asset, basically what cash inflows we will get. Now in equity case, equity case, it is very tough to estimate or predict. Listen to this, it is very tough to estimate or predict that what equity shareholders will get in future, because their dividend rate is not fixed. Their dividend rate amount is not fixed. They will get anything. Whatever earning company will do, whatever earning is available for equity shareholders, every year dividend rate keeps on changing. It is not fixed. But in case of preference shares, their dividend rate is mentioned, fixed. In case of debentures, their interest rate is fixed. In case of bonds, their interest rate is fixed. So their future benefits can be confirmed with conformity, we can say it. But in case of equity shareholders, future cash inflows prediction is tough. That is why their valuation is tough. We do not have to do prediction. Question will tell us how much dividend company will pay. But in real life, valuation of equity share is tough, because we have to predict the dividend rate, which keeps on changing. Because how much dividend company will declare, it is all not pre-decided. So this is what it is written here, and it is dependent upon company's discretion also, how much dividend payout they will do. Okay, so this is the same thing written here. Difficulty arises due to the rate of dividend on equity shares is not known. Payment of equity dividend is discretionary, dependent on company's decision. So basically, amount and timing when the dividend will be paid, how much dividend will be paid, of cash flows expected by equity shareholders are uncertain. But in case of bonds and debentures, this is not uncertain, because the rate of interest in case of bonds and in case of rate of interest, dividend in case of preference shares, both are known with certainty. So hence we can say here that earnings and dividends are expected to grow on equity shares. Then one more thing, one more difficulty. Equity shareholders dividend can grow, but bonds and debentures interest rate is prefixed. It cannot change. So that also creates problem in valuation of equity shares, because there is a growth model also introduced in equity case. So interest on bonds and preference shares are unlikely to grow. So valuation of equity share are tough, and valuation of bonds and debentures are little easy. Okay, this is just a theory portion which is given in the first page of the valuation. Okay, so this much for this session. In the next session, we are going to get more advanced in equity valuation. Fundas are clear. Fundamentally, we have to just learn these 2 formulas, these 2 concepts, that is how to compute present value of perpetuity with no growth, with growth. That's it. In next session, we are going to continue doing questions only, and not much depth we have to now go, just we can directly practice questions. In the next lecture, we are going to do the same. So this much for this session. Have a nice day. Thank you.